building a business is like robbing a bank. He said every single bank has a different exit path, and you have to get out before you get caught.
That it will take 4x that amount. You're going to pay 50% in taxes.
Buyers love that you're messy.
Your systems must be documented. So it's not what you make, it's what you keep.
What makes a company irresistible? Welcome to the Acquirable Podcast, brought to you by Stone Canyon Advisors. We are so excited to have Jim Cunningham on with us today. How you doing, Jim?
Great. Thanks for having me.
Man, we are thrilled to have you. Listen, we are about one thing, helping companies become irresistible when they exit. And we fundamentally know that there's four things that make a company irresistible: efficiencies, financial, culture, and scale. And Jim, you get to sit on the precipice. You get to be in the ground zero, the tension of companies selling. Tell us a little bit about yourself.
Well, I'm an attorney. I've been an attorney for 31 years this year, 31 long years. You do anything for 30 years. And if
Jim,
someone's
you
listening to
barely
this
look
and they have a
31.
business,
You got to be kidding me.
and they go, yeah, that's me. I've been doing this 30 years. I'm going to go fishing. So I'm a lawyer. That's my trade. I'm also a real estate broker. I'm a securities insurance licensed. I'm a pilot, single engine land, instrument
Awesome.
rated, although I'm not current. And you guys are down in San Diego. That's where I was born, at Sharps Hospital.
Let's go.
One of them, which has since been demolished. But I grew up in Southern California and live in Northern California now. We have a firm of about 50 people, so we handle all things peaceful transfer of wealth from one generation to the next. Lots of small business owners, and this is really important. If you're a business owner listening to this, you will stop working one day. It's going to happen. Either you're going to go out voluntarily, involuntarily,
That's
or
right.
you're going to die at your desk kind of thing. You need to have a succession plan. You need to have that in place because someone's going to have to make payroll. If you think about this, like if you pass away, someone's going to have to make payroll. And if you sell, you're going to have to pay taxes. There's a lot of stuff going on. That's what we help people with. So estate planning, helping people minimize taxes, again, peaceful transfer of wealth, and advising businesses on business succession.
Jim, it's funny. I raised quite a bit of money from Insight Partners. It's the largest software-only VC in the world. And I actually got the chance to raise from the founder, Jerry Murdoch. And he always used to say to me, building a business is like robbing a bank. He said, every single bank has a different exit path, and you have to get out before you get caught, because everybody gets caught. And every business gets caught. Time waits for nobody. And it's exactly what you say, that we've got to have plans for transition. Let me ask you this question. We always start this way. Folks that listen to this podcast typically are excited about an exit. They're excited about that, being able to sell their business, travel the world, have generational wealth like you talk about. And they often have this euphoric view of building a business and selling it. But as well as anybody, that building a business is gut-wrenching. Talk to us a little bit about what you've seen from some of these business owners that have gone through the process and just some of the ups and downs that you've gone through.
Well, I mean, a lot of people have built a successful business, and I would say we tend to get those people in. So we're not bankruptcy lawyers, right? A bankruptcy lawyer, if you had a bankruptcy lawyer in here, they'd be like, let me tell you how things go wrong.
Yeah.
I've seen a lot of things go right with clients. I've seen clients build businesses that are really from nothing to massive businesses. A lot of grit, a lot of sweat equity in most cases, a lot of pledging of your personal assets. If you're a business owner listening to this, there's a high probability that 95% of your personal net worth is the business.
That's right.
Right. So a lot of our clients, they build a business, and 10 million is kind of that, I don't want to say entry level, but that's where I think that number, that sort of magic number, is where there really is a business sort of with recurring revenue. Now it could be smaller, but if you built a business that's a $10 million business or more or less, whatever that is, that's really hard. And that's a great thing. And sometimes it takes people 30 years to build it. Sometimes it takes people 3 years to build it. I had a friend who's also a client. He sold his business after he created it. 3 years after he created it, sold it for $14 million.
That's awesome.
Fantastic. He said, I'm not worried about taxes. And then he called me about 6 months later. He goes, Jim, I cried when I wrote the $5 million check. I cried. So I would say first inside tip, if there is one, if you're a business owner and you're selling and you say, my number is this, and everyone has a number. Maybe it's 5 million, 10 million, 20 million, whatever it is. you need to get in your head that it will take 4x that amount to buy the business, because the person who's buying it has to earn the money, 50% in taxes. You sell your business, you're going to pay 50% in taxes, maybe less, maybe 40. But the idea there is, if you want, let's say you want 10 million, someone's going to have to come up with 40 million to buy that.
Yeah, you bring up a really great point that I think because you've seen it intuitively out in the market, that $10 million mark of revenue is where you really start to have a business. And that's interestingly where businesses start to become very acquirable. If you're smaller than that, of course, it depends on margins and what the business is exactly. But generally speaking, companies start to become very acquirable above the $10 million mark. And it's because there's a real business there, and they know it's not just an extension of the founder.
That's good.
That's how I think about it.
So, Jim, when we work with companies, we look at these 4 pillars that we know are true. That when a company says our efficiencies are dialed, our finances are put together, we have a culture that can last transition, and we truly understand revenue and repeatable revenue and scale. A buyer comes in and says, this is real. It's not just an extension of the founder. You didn't just catch lightning in a bottle for a year. You've built consistent things. So we want to spend a little bit of time with you talking about these 4 things and what you've seen and what you think are important from your point of view. I'll let Josh lead off here with our first couple.
Yeah, so I'm going to talk to you about efficiencies and financials, and I just want you to tell us, like Josh said, what have you seen out there? What do you think is important when people are building these companies?
I would say the first thing, if you're a business, actually, as you were talking, I was thinking about buyers. If I'm a buyer, I'm going to want to buy something that's broken, because I'm going to fix it and have some value, right? So I think if you're a buyer listening to this, you're going to pay a premium for about what I'm about to tell you. Is your systems must be documented. This is like a very tactical, just very basic, right? In this, like, literally bonehead basic in the Gen Z sense of the word basic. And if you're not Gen Z, you need to get the Gen Z dictionary, because the words that we all use
stories about that for you. Yeah.
Gen Z uses different words, right? And they mean different things. Do not use punctuation in texting. That's a bad idea. So,
Tell sign, this guy's old. He's using
document your systems. Recurring revenue. These are just basic things. If you are deal, heavily dependent on the personality of the, like a life insurance agent is somebody that is heavily dependent on that individual person. Deal, not a lot of residual revenue. Financial advisors. That's why financial advisory firms sell for these big multiples. Software companies, you can scale rapidly. So I think if you're building your business or you're thinking about selling your business, documenting your processes, thinking about the type of things that you're doing, I'll give you an example. So, and this is publicly available information. A client of mine and a friend of mine, his father founded a very well-known drum company that sold to Roland for $60 million. 30% of that value of that 60 million was software that the son created a few years before the sale of the business.
Unbelievable.
Pissed the dad off. He was pissed.
That's
right?
Incredible, though.
So if you're doing, and now with the age of AI, and this is another reason why it's important to document your processes. In our firm, we are now using agentic workflow, which means AI agent, which is like a little person, okay? And that little person in our organization does things. So data comes in, does things, and then there's an output. So that's very important to have those processes documented, because now if it's all up in your head or it's all in your key people's head, that's a really bad idea. You need to get that documented so that you can use AI to increase your margin and increase your productivity.
Man, that's good. I was, just as a side, I was driving down the car with my 16-year-old son the other day, and he was using all these words. And I said, what does that mean? And he tells me, glazing, all these different things. And by the third time, I was like, what does that mean? And he gave me this like, oh. And I was like, listen, I don't have to talk to you. I got a bunch of calls I can make. I got cool things I can do. I'm trying to talk to you as your father. I don't need to do that. There's a lot of interesting people I can talk to. Or you can educate me on all these words and we can have a relationship. But I think even to that analogy, this is what we're trying to do on this podcast. We're trying to give you new words, new frameworks, new truths that if you don't know these, and you go talk to a buyer, you guys aren't speaking the same language. Like, we don't have our processes documented. Oh my gosh. And to your point, a lot of times, and this is where we think is so important with what we do, a lot of times buyers love that you're messy because they're just going to hack down your multiple and go, this is great that you don't have all this stuff done because we know how to do it turnkey and we'll just bury you in your multiple. But that's why it's so important. That's why this podcast is so important to go, you want to get that big exit. These are things you got to be paying attention to.
Yep, we've seen that in our own practice. So in our practice, we just went through the list. I think we have accreted, absorbed, acquired, whatever you want to call it, about 31 or 32 law practices of different sizes over the last 20 years. And I would say pretty much all of these were kind of broken down on one level or another. I would say at the very threshold, if you're a buyer, a lot of times what people are buying are, like, frankly, a client list, maybe some people. But if you've got, you make widgets or whatever analogy you want, and there's someone in your city that says, hey, I want to sell, you can acquire that client list. So that's a quick way to increase your revenue. I would say the downside, if you're a seller, if you're in a really small town and you have one competitor, that competitor may not want to buy you because those people are just going to have to go, right? They're going to end up going to you anyway. So the other thing too about selling, if you're on the sell side, I really think at a minimum, you need to think 5 years before you sell.
That's right.
Now, some people don't have this option. Now, 5 years is a magic number because that's when that has to do with like converting an S Corp to a C Corp or a C Corp to an S Corp or a partnership or whatever it is. And there's a lot of tax reasons why you'd want to do that. But 5 years in advance helps. And I think you guys probably talk about this in your podcast, to have good financials, a good track record. And also you need to identify all the seller's discretionary earnings, right? Your boat, your apartment rental, your whatever it is, identify that on your financials. And let the buyer know, right? If you're the seller, let the buyer know, hey, this is kind of the stuff I've been running through my business. Because as a buyer, I strip that stuff out anyway. And if I can't find it, I'm really not going to give the seller the credit for that, if that makes sense, right?
Jim, you alluded to it, and I just want you to spend just 60 seconds educating our listeners on qualified small business stock. And I know that you work on that. We have a mutual client, so we know that you've done that for them. 60 seconds, tell us about it.
Yeah, qualified small business stock is an exception. Whenever you hear the word qualified, it means it has to do with the Internal Revenue Code. So qualified plan, whatever it is. So qualified small business stock means that if you invest in certain companies and hold that for 5 years, you can sell the stock in that company. And if that company was created July 6, 2025 and later, you can exempt $15 million per taxpayer per year when you sell that stock. So if you're married, it's 30 million. If you're single, it's 15. If you acquired that stock before July 6th of 2025, then you're limited to 10 million, right? So it's $10 million per taxpayer per year. So we just helped a client. He's started an AI company last year. He's moved some of his qualified small business stock into a trust for his children. So he's going to get 10 million. His wife's going to get 10 million. And that trust for his child is going to get 10 million. So they can exempt 30 million in gain. California ignores it. You're still going to have to pay California income tax. But interestingly enough, New York, the state of New York, allows qualified small business stock, so you don't have to pay tax on that. So if you've got qualified small business stock and you're either California or New York, think about moving to New York.
There you go.
I've seen this come up so much and increasingly so since the pandemic. It's just a thing that people are finally. It's been around since the 90s. Jim, correct me if I'm wrong, but I think it was a Bush era law, and people are just now really starting to understand and take advantage of it. And entrepreneurs are expectant of it. They know about it and they know to ask about it. It's an amazing program.
Yeah. And if you're an advisor, by the way, if you're a lawyer or a CPA and don't know much about this, you really do need to know about it because your clients, I'm telling you this with the AI thing. And just before we got started here, we were trying to look up something. We're both looking it up on ChatGPT. Your clients are going to be using AI. We see this with our clients and probably in the last 90 days. And we're recording this in the summer of 2025. Last 90 days, just a real uptick in clients using AI. We use AI. We use it in a way where we're not sharing that information, obviously, with the large language model. We're doing it consistent with state bar ethics. But we're really leveraging that. If you're not leveraging it, I think that's a mistake.
We agree. We're using it. We're using it at our firm in the same way, like you're talking about, even though we're not part of the bar. But that's, I think, just a good standard for companies when they're using AI, and it's amazing. It's an amazing efficiency driver. We're just talking about efficiencies, and I think that if I were to speak on that right now, I think if you're starting a company or if you're growing a company right now, you need to be thinking about how AI can or should be incorporated into the workflow.
Well, it's interesting about this. So I'm a buyer, right? So we acquire practices. We did 5 acquisitions last year. We're talking to people right now. I take their financials, I put them into ChatGPT,
Yeah.
and I ask the PDF questions.
Mm-hmm.
This is just crazy. So
It
if
is.
you're using ChatGPT as search, that's great. But you can actually put PDF or whatever data into the
Yep.
in ChatGPT.
We just had this conversation with an individual we were working with, and there were some discrepancies. And I said, man, all you'd have to do is upload this into chat and say, show me the discrepancies, show me what's not penciling out. It allows you to save time, save face, and for what, seconds of your time.
And Jim, like, I think, your background probably as an attorney is similar to mine as an investment banker when you come right out of your schooling, right? And you're valued to a firm, and the reason that you get to be part of deals is because you were detail oriented, you caught mistakes, your spreadsheets were perfect, your Word documents, your PowerPoints were perfect, and that is not really a valuable thing anymore. Of course, it still exists because people don't know how to use AI as well as they should and probably will in the next 5 years. But it's different now. You use AI to catch those types of things.
Well, that's your point. It's still perfection is still the bar. You just don't have to deliver it. There's tools to deliver perfection for you. So when you don't do it, you're like, what in the world?
Yeah, I guess at least in what I'm seeing as a lawyer is lawyers who don't use AI will be replaced by lawyers that do. There will still be lawyers. And there was a recent study, 93% of people, and if you're a business owner out there, this is really important. We're not just kind of going on a random left turn. 93% of people recently surveyed would have hired a lawyer, but they didn't have what? Money. If the fees that the lawyer charges, and if you're a business owner, you're going to love what I'm about to say. If the fees that a lawyer is charging for a given service go down, because the time goes down, because the lawyer's using those AI tools, you're going to use that lawyer. The lawyer's going to have more business. Your business is going to run better, right? The lawyer's going to have more clients, and your business is going to run better. And maybe you can learn to use these tools, right?
Yeah.
So I think it's a net positive, but definitely in the space of if you're looking at selling your business, I would really kind of mess around with AI if you haven't done so, and use it.
So the big thing I hear is document your systems for efficiencies. You want to move on to financials?
Yeah, let's talk a bit about financials, Jim. And I love when you talk about any add-on acquisitions you've made, just what you've learned there, what you've seen with clients from a financials and financial reporting standpoint.
Well, we're in an estate planning practice, and I will put a shameless plug for my book, Savvy Estate Planning: What You Need to Know Before You Hire the Right Lawyer. If you are looking for a lawyer, if you're looking for a lawyer to do your estate plan, read that book. It's not going to tell you how to do estate planning, but it's going to tell you to think about all the stuff that you need to think about before you go visit with the lawyer. But on the financials, I would say pet peeves for me, because we need to know where the revenue is coming from. And rather than just saying, sales of goods or legal services as a single line item, I want to know the source of that revenue. However, whatever your industry is, maybe it's geographic, maybe it's types of revenue, but we like to see a real detailed breakdown on revenue. We like to see clean financials. What do clean financials mean? Your balance sheet, there's no reason your balance sheet should not be updated every month. We update ours every day. But you need to have an updated balance sheet. It's not an exercise you go through, in October 12th of the year following, the year, the tax year, right? If you're filing a corporate return, it's not delayed. You need to be paying attention to this. Another one with something we also look at is moving averages. So either a 3-month or a 6-month or a 12-month moving average on different key performance indicators, or KPIs. So if you hear that acronym. So we want to see what are the sales trends, because when we look at financials, if you're looking at the monthly, it's going to be a bunch of ziggly lines. It doesn't really make sense. If you average these out, and you could talk to, maybe accountants know about, this is basic math, this moving average, where a 12-month moving average would be like, in this given month, we're averaging the last 12 months of revenue. And then the prior month, we're averaging the last 12 months of that revenue, for example. that's a lot easier to see a trend. And if you see a dip, there's a problem. So that's what we're looking at financials. And again, clean financials, if you're running a lot of expenses through your business, which if you're a business owner, I have yet to see a business owner that doesn't.
Okay? Right.
You need to identify those. It's okay to do that. No one's going to rat you out, but you need to identify those. And also, I think it's helpful to have, I've heard this number of 40, meaning either 20% margin and 20% growth, or 40% margin and 0% growth. But you want to have healthy margins, and you want to be in a growth. You want to have a history of growth. If your revenue is declining and your margins are low, or your margins are getting squeezed over time, that does not look good for a buyer. Okay. I'm telling you. So a lot of people want to sell in a dip because they go, I just can't handle it. I'm not making any money.
Right.
This is terrible. My margins are getting squeezed. That is not a good time to sell. Now, you may have to sell, but that's not a good time to sell. You want to, when you're in that sort of business cycle, you kind of want to be in the upswing or at the top of the business cycle, not coming down or at the bottom of the business cycle.
Let me tell you, so there's a friend of mine who invested in a health lab, and he called me and he said, "Hey, I don't feel great about this investment. Can you give me some insight on it?" He'd put, I think, 400,000 into this thing. And I said, "Well, send me over the P&Ls. Let's look at what's going on." And he's like, "Well, I don't have them." I'm like, "What do you mean you don't have? You put 400 grand into a business, you don't have them?"
Yeah, nobody feels good about it now.
So then he reaches out to the CEO and says, "Send me the financials." The guy, this was what, 2 months ago? Yeah, and he goes, "I haven't done them for a year."
Oh, wow.
And so the guy's like, "What should I do?" I'm like, "Don't put another penny in there until you see the financials."
Yeah.
Well, long story short, ended up going to litigation because he had committed to give this money. The guy sues him. The whole thing goes bust. And ultimately, the company failed. And I remember just thinking, I said to him, I said, "Man, like, first of all, never invest in a company without seeing financials. Second of all, as CEOs, as you're listening out there, you never know when you should know when you need to raise capital.
Yeah.
But any even moderately sophisticated investor is going to want to see up-to-date P&Ls, be able to evaluate the business, even if it's like, hey, can I get another infusion of cash as a cash call a year later? Fine. Let me see the books. And as an investor, you should be looking at those anyway. But the whole company ended up imploding last week.
Yeah. Wow. That's a great story. It's amazing how much this comes up. Jim, it comes up for you because you're in a similar flow of deals like we are.
Yeah.
But on this podcast, even when you talk to folks who've been through an exit, they're shocked and surprised at how much the buyers cared about the financials. And I think the most important thing for listeners is to just know it's table stakes.
It is.
You just have to have clean financials, and you have to have them timely.
Well, and if you don't have clean financials, people will stop looking. They'll
That's
just
right.
move on to another
right.
deal.
It's
I mean,
a
that's,
fast
you know,
no. It's an easy way to say no quickly.
Very resistible.
Very resistible. as
Using
you
our
call it,
language.
yeah.
Very resistible. Jim, let me move on to the next one, which is culture. And we were just talking the story. There was a CEO we've worked with in the past, and one of the buyers had asked, like, "Hey, what does it look like to attract new talent to this business?" And the individual's like, "We don't need to attract. We have plenty." Wrong answer. Wrong answer. And culture is everything when it comes down to saying, do these people staying? Do they believe in the mission, the mandate, the multiples, what we talk about? Let's talk a little bit about culture and what you've seen in businesses that have made them sticky or fragile.
Yeah. I would say that if a business owner does not have a baseline growth mindset, and this does tie into culture, if the business owner does not have a baseline growth mindset, that will negatively affect your valuation at exit. Now, what I mean by that is people are always leaving, people are retiring, whatever they're doing. If people say, "I've got everyone I need, I don't need anyone," well, what if somebody leaves? Or what if you have, your sales increase by 20% and you need more people? So I think having a growth mindset is very important. It's also very important that people take vacation. They leave. Certainly a lot of law firms, they say, "Oh, we don't have or a lot of companies, we don't have a vacation policy." People can take whenever they want. When you have unlimited PTO, people never take PTO. People need to take PTO because they may leave, and you need to make sure that your processes are documented, like you go back to the first point, right? And you need to make sure that your company can run without these people. And I would say another thing culturally is, and I've seen this, I'm in a CEO group, a national or international CEO group, and some of my members have California companies that have been acquired by private equity, and now they have led and are leading companies with locations in different states.
Hmm.
Now, we're doing this from California. You're in San Diego. I'm in Sacramento. We're in the California bubble. This is a very multicultural. I would say California, broadly speaking, has a very high tolerance for people who don't look like you, talk like you, eat the same food you do. You go to Oklahoma, that is not what's going on.
True.
Okay. And I'm not throwing shade in Oklahoma. I'm just saying, pick the Midwest. It's different there. Okay. That is a cultural aspect. So if you are outside of California looking to acquire a California company, I think that's something you need to be thinking about, because I think it's harder to attract if you are, it's harder to attract the best people if you're not open to hiring people who may not agree with you politically, may not agree with, may just be different across the board.
Let me ask you a question as it relates, because this is what define attracting the best people. Define best people. Give me some of the characteristics, some of the things you've seen of great, like what makes a great individual come into your firm or anybody's company.
Yeah. So Pat Lencioni, I don't know if you guys are
Love
familiar
him.
with him. He's out of the Bay Area in San
Love him.
Francisco Bay Area. He talks about being hungry, humble, and smart. Great book. He's got a great series of books. Hungry. Somebody is not literally hungry, like I'm starving. Somebody's hungry for knowledge, a thirst to grow, to improve themselves. So hungry. Humble is not thinking less about yourself, but thinking, it's not thinking less of yourself, but less about yourself. And he has a much more articulate way of saying it, but basically empathy, thinking about other people first. So hungry, humble, and smart. Smart is not, intelligence. Smart is, can you read a room? Do you know if somebody's pissed off sitting across the table from you, right? So hungry, humble, and smart. If you're missing one of those things, maybe you can work and improve them. If you're missing two, that's really hard to deal with. The most dangerous person, I will say, is the person who is hungry, smart, but not humble, because they can hide it.
Yep, that's right.
That's right. Those are some dangerous people.
That's right. I love this idea of culture, and I think, when I ran my software companies, I loved doing unlimited PTO because nobody ever took it, and we got a bunch of shit done, and it was fantastic. But you bring up an absolutely imperative point, which I'd even go back to efficiencies kind of in our process thing of saying, if you don't have a process for people to leave that office and not skip a beat, that's also going to be a major cultural ding, because to your point, if nobody's here, if somebody listens, we cannot lose a minute. And so I love that concept of saying, and I've never thought I'd say this in my entire life, start to elevate PTO.
Yeah. I've been in environments, I've led companies where we have unlimited PTO and where we don't, right? Where we have the unlimited PTO. I don't remember what we call that, old-fashioned PTO, but it's true. Nobody takes unlimited PTO. And I think as a leader, it's imperative you realize that and at least are intentional about it. Setting a tone or a culture, if you're going to have unlimited PTO, setting a tone and culture that it's okay to take vacation. It's expected that you leave.
Yeah. And especially, and you may think, well, I own the company. Well, that's for the other people. It's not for me. I will say that it takes a heavy dose of humility to let other people do. And let me say that again. If you're the business owner, it takes a heavy dose of humility to let other people do what maybe only you can do. I think it's a mistake for a business owner to let themselves be the only person who can do, obviously, like running a company that's just you. But what I'm saying is certainly in a professional services organization, maybe it's a little bit different than a typical business, but we're not going to take any case that only I can do, right? That's not fair. That is not fair to my partners. It's not fair to the associate attorneys. It's not fair to the paralegals. I'm stealing from them because we're about constant improvement at our firm. We're always learning. We're always improving. Because that's the nature of the legal profession in 2025. If you're not doing that, I think you're making a big mistake.
It is the most common thing I see with founders, no matter how long ago it was they founded the company. It could be 4 decades ago. There is something that is really hard for them to give up as the thing only they can do. Yeah. It's usually the last thing I see to go in a succession plan is that there's something there that they're holding on to. I think about that all the time. As a founder and CEO, I think about it all the time. What is it, the things that I feel like only I can do, and how do we make sure someone else can do them? That's good.
Yeah, we had a speaker years ago at our CEO group. He said, if you remove yourself from your organization as the leader a day a week a week a month, and a month a year. So just think about this. You're not going to work on Friday. Let's just pick Friday. You're not going to work the third week of the month. And you're not going to work in July. Just picking random times. You will not work 2,000 hours a year. You'll work 1,000 hours a year. You'll cut your time in half. I just came off of a 3-week trip, 3.5-week trip I took with my wife, totally disconnected, 9 hours away, time-wise. I couldn't even be at work. I've set it up where the firm ran fine. There were 2 small hiccups. One was a good hiccup and one was not so good. But 2 small hiccups, but they were handled with the people that stayed there. If you don't do that, by the way, if I'm looking at acquiring a practice and the lawyer says, yeah, I hardly work there, I like that because we used to just like to get the client list.
Yep.
Well, now we like to get the associate attorneys, maybe some partners and the paralegals and the people, because we need people to get the work done, right?
That's right.
Even in the age of AI, we still need people to get the work done. So if you're looking at selling and your buyer wants all of your employees, which I think most deals, if you're over 10 million, I would say that's most deals. It's a lot better if you, the owner, are an absentee owner. And if you're there every day, 12 hours a day, a buyer's going to be like, wait a minute, I don't know about that.
Right. Let me ask you a question. When you've, some of your acquisitions, give us a story or some insights into maybe some cultural acquisitions that weren't a great fit and some of the maneuvering you had to do. What have you learned about kind of evaluating, going, man, we've just picked up this firm. This wasn't the best fit.
I would say we've done a lot of deals. I would say 1/3 of the deals are fantastic. 1/3, I wish I would have never met that person. And 1/3 are like, meh. The ones where I wish I never would have met that person, these were typically prickly people. Now, it's been said, and this is a little woo-woo, and if you're not in California, you're going to be like, this is all like crystals and like, hippie shit. Like attracts like. So if you're a prickly lawyer, your clients tend to be pricklier. What do I mean? What do I mean by prickly? I mean, not grateful, slow payers. They want a bunch of stuff for free, ungrateful, terrible on your staff. We fire those clients. What we've found is if the selling attorney is kind of a jerk, the clients are kind of jerks.
Interesting.
So I don't know if the same translate, if you're manufacturing sheet aluminum, I mean, I don't know if the same holds. I have no idea. But I think that's something in our experience we've seen is if the seller's prickly, the clients are prickly.
I think where it does definitely hold is attracting talent. When you're a life-giving leader, when you are a encourager, when you're a developer of talent, you're going to find those people. When you're cold and icy and blocked off, typically, so you'll end up finding maybe from an employee set for sure. I don't know about a client set in some of these, but from an employee set, you're going to see that commonality.
You're going to attract an environment, or you're going to create an environment that attracts the type of person that's comfortable in it.
Yeah.
I mean, that makes sense.
That's how it manifests.
Yeah. Hey, let's talk about our fourth pillar that we know to be true, which is scale and revenue. I was just telling this story when I was selling my software company. They were saying, hey, love the growth, less worried about that, want to look at churn. We want to see what the underbelly is happening inside of this thing. Are clients staying? Are you expanding share of wallet? Like, it's great that you have a front growth motion, but part of scaling revenue is keeping clients and saying, I don't want to deal with a bunch of turnover. But talk to us a little about what you've seen in terms of just revenue and scale and the value of that.
Well, revenue if you're talking, there's like as you're talking, I'm thinking top line revenue and I'm thinking margin, right? So I'm thinking of what you keep. So it's not what you make, it's what you keep. I weigh those. I guess are weighed differently. Certainly having top line growth is good. It's better than not having top line growth. I think it's also very important to pay attention to what you're keeping. But I would say that let's go back a little bit in time to before COVID. Everything costs, insert a percentage higher. Is it 30% more? Is it 50? If it's housing, Josh, we were talking about this a few meetings ago. We're in a networking meeting together. Housing is 3 times as much, 4 times when you look at the payment because of interest rates. But if your company did 10 million in 2020, it needs to be doing like 14 million in 2026 to stay. Yeah. And that's no growth, by the way, because that's just adjusting for inflation. So it's very important to have top line growth. But in terms of scaling, different businesses are different. Software, easily scalable. I mean, to your point, you have a higher valuation on software, broadly speaking. Professional services, very low valuation. Law practices often trade at 40, 50% of like trailing 3-year average top line revenue. So very, very small multiples. Those are the deals that we see.
Yep.
Sometimes people overpay. Those we put in the class of irrational competitor. If somebody wants to pay more, great, go for it.
Yeah, let them do the deal.
But I would pay attention to top line revenue and also the margin. So a lot of private equity, when they go to acquire a company, they look at what's your revenue growth. So if it's 20% and your margin is 20%, that number's 40. You put those together. If your growth is 30% or 10% margin or 10% growth and 30% margin, that may be a threshold that acquirer requires just to do a deal. So if you've got a 12% margin, you're growing at 10%, I think your multiple would be a lot lower. I mean, you guys would know more than I would. But maybe are we going to talk about deal structure? Because I think it maybe ties to finances. So
Yes,
a lot of people.
We're going to finish off with deal structure. Josh will kind of finish up a little bit with that. But I like what you're talking about. It's not what you make, it's what you keep. I want to hold on to that because I think so many business owners a lot of them are growth mindset. But what they're not is efficiency mindset, financial mindset, culture mindset, but they're growth mindset. And so they walk into a deal and say, look at all of our growth, which is great. And when you think about scale and revenue, but where it's always missed is that underbelly of saying what you keep. Are you running this business well? And I just think it's worth double tapping on that because it's so easy to go put more flour, more water, more flour, more water. Let's keep going. And you're missing the actual, when they talk about scale, it's not what you make, it's what you keep.
Yeah, and I think there's a qualitative difference in when you're talking about what type of business. If it is software, if it's like VC funded, you don't even want to make money. Now, the reason
I know.
If you have a startup and are immediately making money, you're not going to get anywhere.
That's right.
Because if you can do it that quick and easily, a competitor can do it that quick and easily. So, that's why you say, well, Amazon had like no profit for all these years and was a multi-trillion-dollar company before whatever it was before they even turned a profit. There's a reason because what they're doing is really, really, really hard.
Yep.
Right.
Yeah, and I would
say
it's
got a benefit way down the road. Again, if you're a construction firm, you need to be making money.
Yep.
Right.
And I would say too, even in the case of the software company where there's an expectation you're not making money, I differentiate in my mind expenses for moat building, we call it. We talk sometimes about moats when we talk about scale. So an expense for moat building is, if you back that out, would the unit economics of the company be profitable? Yes or no? Even if you take all of the profit that was made kind of at the unit level, gross margin, whatever the measure is that you're thinking about for unit economics, and dumped it into growth, it still has to be a business where the unit economics can be or should be profitable.
Yeah, I'm glad you mentioned that because whoever's listening to this, you might be on a walk and have like your earbuds in your ear and you're the only person listening to this. I mean, I think a lot of people, that's how they consume this type of media. If you're selling a business, a brick and mortar business with humans and doing physical labor, that is fundamentally different than software, right? So I think it's really important to work with somebody like you, like your company. Like this is what I do. How do we tune what I'm doing to what path should I take in terms of building my company for the next 5 years? And I will say, I think it's really, really important and I'll go back to this. It's really important to have that time horizon. I think 5 years is a minimum. 8 to me is better. But guess what, people? If you have a business, you need a succession plan from the get-go. Because I think it's a mistake as a business owner to build something without the end in mind, without the exit in mind. You have to think about the exit because it's going to happen. And you may say, well, I'll just die, whatever. I'll die at my desk. I'll die on the ladder. If you have a spouse, they're going to have to take care of it. If you have employees, someone's going to have to make payroll, right? And this has happened so many times where people pass away owning a business. The spouse comes in, the kids come in, they're panicked. They say, we have to make payroll in 48 hours. We don't even have the corporate paperwork set up to access the bank account. Wow. Like it's that bad. So I would say basic level, this is kind of in the estate planning zone, you need to get the structures in place, whether it's a buy-sell or your living trust centered estate plan or your corporate documents, you got to make sure those are in order so that if something does happen, your business can continue to run. By the way, if you're just a little fun fact, if you're a dentist listening to this, and you stop practicing dentistry, your practice must change hands within 30 days. Otherwise, under California state law, it's shut down.
No way.
Yeah, it's because they
Wow.
have big piles of cocaine in the back.
Yeah, exactly. Well, hey, let's talk a little about deal structures. We finish out here our time together, and why don't you guys spend time on that?
Yeah, Jim, we're really curious again about these add-on acquisitions you've done. Just talk us through the structures there, and then any commentary you have about clients you've seen and kind of deal structures.
Yeah.
Particularly, you know a lot about structures and how they impact kind of what you keep in a transaction.
Yeah, we help people in the M&A space sell their business. We help more frequently with the tax. Obviously, if we're selling their business, we're helping with tax planning. But a lot of M&A lawyers come to us and they say, Jim, this is what the client wants to do. How can we minimize the taxes? Because some of these numbers are really big. Especially if you're a California resident, you got that extra 13.3% on top of everything else. But deal structures, I would say, if I'm a seller, I want a big check. Not like a big, like the poster check, the charity check kind of thing that's like 5 feet wide. I want a lot of numbers. I want it right now. I want to leave. I want to never hear from the buyer again. And I just want to, sit on my boat in Cabo, whatever. If I'm a buyer, I want to pay you a lot later than now. I want to have all these conditions and I want you to work slavishly for the next 5 or 8 years or 10 years or whatever it is. So deals happen somewhere in between those two. If a person is getting a check and leaving, a lot of times it's for less money than if they stick around. So deals can be structured like this. It's very common in law or professional services to have an earnout. They say, okay, we will pay you 20% for 2 years. That's a very common number in my space. Somebody might say, well, I want money up front. Okay, well, we're going to take, if your firm's doing $1 million in revenue, we'd pay you 400. We'll pay you 200 up front and bear the risk, right? Because we don't know what's going to happen. There's risk in there for a buyer. So it would be less up front. Another one is let's say you're buying a company for 10 million and you say, I'm buying this for 10 million. I've got 4 million to write a check to the person, right? So I can write the check for 4 million, but this other 6, you can either finance it with the bank or you can say, I will pay you in the future, right? 3 years from now, I will pay you $200,000. A year after that, I'll pay another 200. A year after that, I'll pay you another 200. And those are the terms of the deal. So it's almost like an installment sale. That helps the seller plan for taxes because if you're married filing jointly and have zero income, or you can have up to $94,000 in income and not pay any capital gains tax federally, $94,000, $95,000. So sometimes it's really good to spread that income out on a smaller number. So actually, it was 2 million, not 200,000. I was thinking $1 million. So you can spread those payments out, and you can have essentially clawback in there. So you can say, look, if these people leave, if this happens, then I'm not going to pay you as much. So rather than going to a bank and getting a loan and paying the person 10 million, you can spread it out. Obviously, you can do something, in the middle. But a very important thing to realize: if you are buying a company, you have to earn money. If you're a California resident, you're probably in a 50% tax bracket if you're over 700,000 in income. You have to save that money and then pay the tax and use that money to buy the company. Then the person who's selling the company is going to be taxed somewhere between 37 and 53% if they're in California on the sale of that company. I'm assuming it's not a stock sale, like in their out-of-state resident or something, but that's a lot of tax to be paid. There are other ways to get there, and there's a thought leader out there who has 4 ways to exit. There's an innie transaction, there's an outie, there's a passer, and a squeezer. An inside transaction is like a sale to key people.
Yeah.
The problem is a lot of times the key people don't have money.
Right.
Then there's an outside transaction. It's kind of what we've been talking about, selling to a third-party buyer. A passer is someone who gives it to their kids. Now, this raises a big issue. If you have more than one kid and you pass the business to one kid, you're going to have to equalize it somehow. That's where you need some good estate planning.
Wow.
Then there's a squeezer, which I hope you're not a squeezer. A squeezer wrings every last ounce of value out of their business, and then they close the doors.
Wow.
Right.
But I think to your point, squeezers are folks that never had these fundamentals down. They weren't,
Yeah.
they really weren't planning 5, 8 years out. They really weren't working the fundamentals of their business. And a lot of times I'm assuming there's a decent amount of squeezers that feel like this is my only option. Because I
Oh
really
yeah.
don't have the knowledge and the domain knowledge to navigate this well.
And here's the real truth. I've sat front row on many a squeezer transaction, and they don't go the way people think they're going to go. And you lose a lot of money that you didn't plan to lose in the process of squeezing.
I guess there's the last part of this. I don't want to end on a negative. Sometimes companies can have negative value. And I think and a squeezer probably has negative value, and that's why they're squeezing it. I would say for a lot of the lawyers where we've taken over their practices, we are doing them and their family a tremendous favor. So a lot of people say, well, I've been doing this forever. I've got this great reputation. Yeah, and you're going to have warranty work that comes back, or service work, or
Right.
refunds, or whatever it is. Or you might, like as lawyers, we have a ton of data we have to deal with. Clients will say, I've got 100 boxes of files. And I think to myself, oh my God, this is going to be like, I have to take care of that. So there is a corresponding liability, right? And I think a lot of people, they may say, oh, well, I'm making $500,000 a year. Okay, well, it's all on you. You're a criminal attorney. There's not a lot of there.
Right.
Yeah.
Hey, as we finish up, I want to just ask you this question we always ask. If you were to just define, somebody came to you and said, Jim, what makes a company irresistible to a buyer? And you just had to kind of napkin answer that question. What makes a company irresistible to a buyer?
Well, growing revenues, great margin, basically free. So
Yeah. But that's a
those
great
happen.
point.
Those
Yes.
happen.
I love that though. But what a great mindset to say,
Yeah.
I'm going to build a business that's irresistible because a buyer is going to come in and say, this is a no-brainer. This is an
Yeah.
absolute
Right.
no-brainer.
I guess effectively free might make sense, because if you've got something like, we can identify a law practice and we have the people and the resources and the skill set to turn a profit on that. Now, the seller is going to participate in some of that profit, but they're not going to get all of it,
Right.
right? Because we're adding value in that situation, but they're going to get their corresponding value.
I love that. Man, Jim, thank you so much just for spending time with us.
Sure.
What a knowledge. Goodness gracious.
I know. Yeah, he's a whiz.
Yeah.
Great.
No kidding, man. No kidding.
You guys are great.
Hey, absolutely our privilege to share time
you.
with you. Thank you for coming in and doing this. And we can't wait to share more time with you and help educate people on building irresistible companies.
Thanks for having me.
Our pleasure.